Okay, let's just jump right into this because if you know anything about value investing, you know there are two types of people. You've got the traders buzzing around, moving at the speed of light, and then you have, well, the monks.
The monks, I love that description. The ones who buy something and then just sit on their hands
Yeah.
for like a decade.
Exactly. And Guy Spier is supposed to be the abbot of that monastery. He runs the Aquamarine Fund. He's a huge disciple of Warren Buffett. And he is famous for one thing above all else, doing nothing.
Total inactivity. He preaches patience, the coffee can portfolio. You buy it, you stick it in a coffee can, and you forget about it for 20 years. His fund is usually the financial equivalent of watching paint dry.
That's a compliment in this world. But
That's
then we get the 13F filing for the fourth quarter of 2025. And the monk did not just meditate this quarter.
No, he did not.
It wasn't just a little trim here and there. It was a demolition, a clean sweep, as the analysts are calling it. We're talking massive liquidations of stocks he's held forever. It's like the monk just flipped the table over and stormed out.
It is a radical shift. And honestly, at first glance, it looks a bit like panic, but you have to dig deeper. It's not just the trades. You have to connect it to this new, really provocative essay he just published.
Oh, right. The one titled The End of the Golden Age of Value Investing.
That's the one. The title alone is something.
It sounds like the party is over. So that's our mission for this deep dive. We're going to connect the trades to the philosophy. We need to figure out why a die-hard Buffett fan is dumping his compounders and what that tells all of us about picking stocks now that AI is everywhere.
The whole game is changing.
It really feels like it. And one of the big themes here is just valuation, the idea that things have gotten too hot, too expensive. And speaking of the market's temperature, if you're ever wondering if we're in a bubble, we actually have a great tool for that.
We do. To track total market temperature, you should search for and download our iOS app Buffett Indicator right from the Apple App Store.
Apple Store
And just before we get into the nitty-gritty, the usual disclaimer. All the analysis we're about to do is based on public sources, and it's for educational purposes only. It is not investment advice. Please do your own due diligence before making any decisions.
All right, let's get into it. The clean sweep. Now, for anyone who doesn't obsessively check SEC filings, they are usually so boring. A manager sells 2%, buys 1%. It's just housekeeping.
Right, portfolio maintenance.
But this was a statement. And the biggest casualty, the one that really just floored me, was Micron Technology, ticker MU. He sold every single share.
100% gone. And this is a huge deal because Spier and other big value guys like Li Lu, they had this whole thesis built around Micron. They believed the memory chip industry had finally grown up.
Okay, what does that mean, grown up?
Well, historically, making memory chips was a terrible cutthroat business, just a brutal race to the bottom on price. But over time, almost everyone went broke, leaving just 3 big players, an oligopoly.
And the theory was, with only 3 players, they wouldn't kill each other on price anymore.
Exactly. They would act rationally, you get stable profits, this super cycle of earnings, especially with AI needing all that high-end memory. Spier was a true believer. Earlier in 2025, he was on record predicting 15% annual returns from Micron.
So to go from 15% returns to sell everything in just a few months, that's a classic thesis break. What happened?
I think it's 2 things. The first is just mental energy. Micron is a roller coaster. It's up 50%, down 40%. It's exhausting to own. But the deeper reason, and this ties into his whole new philosophy, is a new fear about AI.
Wait, I thought AI was supposed to be great for chip makers.
It is, in terms of demand. But what if AI gets so good that it completely commoditizes the hardware? What if AI can design better chips faster? Or optimize manufacturing so well that supply just explodes?
Then that protective moat, it's gone.
It vanishes. And you're right back to selling a commodity where the only thing that matters is price. He's decided he doesn't want to play that game anymore.
Okay, that makes a weird kind of sense. But the next one, this one hurts. He sold 100% of Alphabet. Google.
This is the bullseye for his AI threat thesis. And it should really make everyone listening just pause for a second. Think about how Google makes money. You search, you get 10 blue links, you click around, you see ads.
The cash cow of the internet for 20 years.
But when you use an LLM, a ChatGPT or a Claude, you don't do that. You just ask a question and it gives you the answer. No links.
And if I'm not clicking links?
You're not seeing ads. And if you're not seeing ads, Google doesn't get paid. The entire economic model starts to break down. Even if they cram AI into their search, it's way more expensive for them to run, and it eats their own ad revenue.
So the search moat, which felt like the safest business in the world, is suddenly a huge risk.
Precisely. Spier is saying, I have no idea how this plays out, so I'm out. He's just taking the risk off the table completely.
Wow. Okay, one more big exit. Bank of America. He sells it all. Now, Spier loves to copy Buffett, and Buffett loves Bank of America, so why break with the master here?
This is more speculative, but it fits the pattern. It's that Red Queen effect again, from Alice in Wonderland.
You have to run as fast as you can just to stay in the same place.
Exactly. For big banks, the threat is fintech. Apple Pay, digital wallets, all of it. Their old moat was having a branch on every corner. Now, that's just a bunch of expensive real estate.
So the theme is, if the business model is complicated or threatened by AI and disruption, he's just selling.
He's clearing out the too hard pile, absolutely.
But it's not just the problem children. He also took a chainsaw to some of his biggest winners. And to me, this is even more interesting. Selling a loser is easy. Selling a winner is hard.
It's the hardest thing to do in investing. Let's talk about these cannibal trims. He still loves the businesses, but he hates the price.
First up, American Express. He sold 69% of his position.
Just massive profit-taking. Amex is a phenomenal business, but the price people were willing to pay for it just went into the stratosphere. It became a bubble stock.
And Spier is famously allergic to bubbles. He has this whole checklist thing, right?
He does. And a big part of it is avoiding the nifty 50 trap from the 1970s.
Right. For anyone who wasn't around, that was when everyone decided there were 50 perfect stocks you could just buy at any price and hold forever.
And the companies themselves actually did fine. They kept growing, but the stocks got obliterated because the starting valuation was just insane. You can love the business but hate the stock if you pay too much.
Which is what he sees happening with Amex.
And Ferrari, too. Ticker is RACE. He sold half his stake.
But he calls Ferrari the perfect business, the Veblen paradox. The more expensive it is, the more people want one.
Yes, but that logic doesn't apply to the stock price forever. I mean, it's a car company trading at a price-to-earnings ratio over 50.
That's a tech multiple.
It's a software model. And he's basically saying, I love this business, but this price is ludicrous. It's pure valuation discipline.
So we've got the sweep of broken companies and the trims of expensive companies. But this all comes back to that article you mentioned, the end of the golden age. This sounds like a huge philosophical change for him.
It is. This is really the heart of the whole story. He's arguing that the fundamental way value investors made money for 100 years is now broken.
How? What's broken?
The informational edge. The whole game used to be about finding out something that other people didn't know. You'd read the footnotes in the annual report, call up suppliers, do the grunt work.
The scuttlebutt, as Phil Fisher called it.
Exactly. But now you have AI. An LLM can read 10,000 pages of documents in a second and tell you every important detail. The information advantage is gone because everyone gets the same information at the exact same time.
So that little secret I found on page 104 of the 10K.
The AI found it 3 milliseconds after it was filed. He uses that Red Queen analogy again. Everyone is using AI to run faster and faster, but since we're all doing it, no one is actually getting ahead. There's no alpha left in pure analysis.
That is a terrifying thought for an active investor. If you can't out-analyze the machine, what's left?
You have to pivot. You have to play a game the machine can't play. You pivot to things that require human connection, trust, relationships.
Which brings us to the craziest part of this whole thing.
Yeah.
As he's pulling back from the U.S., he's going all in on India.
Yes. The Indian gambit. This is where the money's going.
Okay, explain this. Is this just a simple emerging markets play?
Not at all. It starts with a very specific macro idea he calls sovereign rating arbitrage. He believes the big Western rating agencies, S&P, Moody's, are biased and systematically underrate India. They give it a BBB rating.
Which is basically one step above junk.
Right. And Spier thinks that's absurd for the 5th largest economy in the world that's growing at 7%. He thinks assets in India are mispriced because the country's risk is being overstated.
Interesting. So how's he playing it? Not just buying an ETF, I assume.
No, he's buying the pipes, the infrastructure of the market itself. His big position is in a company called CareEdge, or Care Ratings. He owns something like 2% of the whole company.
So it's an Indian Moody's?
It's the Moody's of India. And he knows that business model is a toll road. If you want to issue bonds in India's growing market, you have to pay them for a rating. But here's the kicker.
Go on.
CareEdge has started rating other countries, directly competing with the U.S. agencies. They are trying to disrupt the whole global rating system. It's a huge, bold bet.
Wow. And he's also in the Indian Energy Exchange.
IEX.
Yeah.
Another toll road. Monopoly on power trading as the country electrifies.
So how does this connect back to the human connection thing? Why can't an AI just figure this stuff out?
Because doing business in India is still very relationship-based. It's about opaque networks, family histories, reputation. It's things you can't find in a public filing.
Stuff an AI in California can't decipher.
Exactly. An AI can read a balance sheet, but it can't sit in a boardroom in Mumbai and gauge trustworthiness. He's moving from a game of data analysis to a game of relationship capital.
That's fascinating. So let's pull back. When you look at what's left in the Aquamarine Fund today, what does it look like?
It looks like a fortress built for a storm. The top holding is Berkshire Hathaway at over 30% of the entire fund. Then you have Amex, MasterCard, Moody's.
A portfolio of royalty streams.
Totally. Credit card swipes and bond ratings. It's designed for survival, not for shooting the lights out. But we have to talk about the elephant in the room. Why this huge change right now?
Yeah, what was the trigger?
The trigger was the lost decade. Let's be blunt about the performance. Since about 2017, Aquamarine has underperformed the S&P 500.
Ouch. For a value investing legend, that's gotta hurt.
It does. And a big reason is that he missed the Mag 7. He was too disciplined on valuation to buy NVIDIA or Microsoft or Amazon during that epic run.
So he was sitting on the sidelines holding boring old banks while the tech party was raging.
And underperforming for that long. It forces you to question everything, this whole clean sweep, this restructuring. It's him admitting, I can't win this game. I can't beat the AI-fueled momentum market, so I'm not going to try. I'm taking my chips off the table.
So he's not selling out of panic, he's preparing.
He's preparing for the next golden age, the golden age of panic. He's sitting on Berkshire and cash, waiting for this bubble to pop, and when it does, he'll have the money to go shopping when everyone else is terrified.
So to bring this home, what's the takeaway for you, for the listener who's maybe looking at their own stocks right now?
I think it's a really profound question. If a guy like Guy Spier, a professional who lives and breathes this stuff, thinks the informational edge is dead,
Then what chance do I have trying to trade based on a headline I saw on Twitter?
none.
No.
You're playing a game that the machine has already won. It suggests the only durable edge we have left as humans is behavioral. Can you be patient when others are greedy? Can you be brave when others are fearful?
In a world of artificial intelligence, being a disciplined human is the only real asset.
That's it. That's the whole game now.
Well, this has been an incredible deep dive. Before we wrap, if you want to hear more discussions like this, you can get access to more advanced content by joining our Deep Value Club membership, or by subscribing to us on Apple or Spotify podcasts. Just search for Deep Value Investing and luluvc.com.
We'll leave you with one final thought. We live in a world where AI gets smarter by the second. It can read faster, analyze faster, and trade faster than any of us ever could.
But it can't be patient. It has no concept of just sitting still.
And maybe, just maybe, the only true edge left is the uniquely human ability to do